Daniel
Thanks,
Hussey,
Earl.
how are you? Welcome to F.A.C.E. Welcome back to F.A.C.E.
There we go. Now I'm unmuted and I can finally be heard.
Yeah, how you
Good.
doing?
Thanks for having me back.
Yeah, Dan, we've been talking for years, haven't we?
Yeah, we have all the way back days when I was with Elliott Wave Forecast before, where I learned to master Elliott Wave and other forms of strategies and have, evolved since then, right? And I think we've all, that is trading, right? And that is
Yeah.
every one of us can, I think that's kind of the theme in all of these interviews, right? Is how have we evolved personally as a trader and what can we see in the markets today?
Yeah. Well, have you had any real important epiphanies and breakthroughs over, say, the last 2 years? Because people think that, you learn and you're done, but you're always learning because everything's always changing.
Yeah, it never ends, right?
Ever changing.
The biggest epiphany I think I personally had, you think you get to a point in your career where I've mastered everything I need to know about futures. I'm a commodities and futures broker. So those of you that don't know me, I began my career on the floor of the Mercantile Exchange as a running clerk, became an arbitrage clerk. That's the guys that are doing the fun hand signals.
When were you there?
I was.
Go ahead.
I was there the summer of 2005, the summer of 2006 and 7. During my tenure at college, I was able to work on the floor back then. And then, going through university and coming out through the, economic recession, the great economic recession, as we call it, it was really, coming out in a firestorm in the marketplace, which was just a great time, in my opinion, to have started my career as a true professional trader, because I got to see markets at their worst, right? This was a time when we didn't know if the housing market was going to recover. The stock market had lost over 50% of its value. People truly didn't know if they were going to have a job in our industry. I saw kids, right, not get offers pulled from different institutions. But anyway, it was a great time to come of age, so to speak, because it definitely, didn't leave any room for hubris or arrogance in a trader.
Well, you know what? Not only a great time, I was talking about it being a great place this morning with our community that, and the closest thing you have to a trading floor, an exchange, a trading pit right now is a good, strong community, which is pretty similar because you have guys that'll be talking about levels, just like the floor traders would have their deck where all the stops were. And, you were lucky. You caught the tail end of open outcry down there, Dan.
I did, and you're right.
Where do you go? Oh, there you are.
Yeah. Oh. I wish I had a better cutout of just me, but that's okay. We'll get to the charts in a second.
Okay.
Yeah. So from there, I learned everything I could about the floor, but it was a dead and dying institution. The floor traders I worked for, the brokers I worked for, in fact, they gave me the probably the best advice I've ever had in my career, which was you need to finish school and learn how this industry is run off the floor behind a screen at a big bank or another institution, because that's the future. And that has not guided me or misguided me at any point. So I leveraged my IT background from school, learned how to program, and that became a very, very marketable trait in this 2009 through 2015 era, where we saw this graduation of floor traders into, the electronic realm. And a lot of these guys were looking for somebody like me that could put their ideas into a computer and help them automate, help them, see it on the charts, whatever it was to them, right? It was an evolution of trading for many career traders that have been doing this for decades.
Many could not make the transition. Many could not make the transition because they really didn't have to be right directionally on the floor to make a lot of money. They could fill paper, they could scalp, the bid offer, and they didn't have to know if a market was going up or down.
And trading off of order flow, which you're referring to here, evolved to, nanoseconds. Yeah. You needed to
next step.
Co-locate a server and be able to sniff network data to determine what the market's doing. That isn't, in so many ways, it is what floor traders did, but at the speed of man. Now it's being done at almost approaching the speed of light by computers, which was just not, nobody in a point and click setting can compete with that type of order flow trading. But that doesn't mean
let
that
me tell you a funny story. When I had my seat on the IOM, and I really didn't like being in the pit. I didn't like out trade risk, etc. And I stood on the side with guys, and a lot of brokers had clerks that were technicians for them. And I knew this one guy's name was Drew, and he did point and figure freehand on an index card. And when he'd get a signal, he'd run out to his buddy, the floor trader, and give him the signal. That's how prehistoric it was.
Yeah, and I remember guys with their,
and they made millions.
Absolutely, decks of all their analysis they had done the night before, the daily, the weekly, the monthly printouts, the hand drawn technicals that we do now. It was a different world, and there was a different skill set involved, right? These guys had become the masters of that trade. And then the trade changed. Things went electronic in the late 80s, 90s. That is when we finally had that circumvention of volumes into the electronic market. And I think in a real way, a lot of people knew that it, on a long enough time frame, right, it was going to end. It's just nobody wants to see things change, and the old ways of doing business, so to speak, weren't really that bad or inefficient. It just new markets come around, and now we have to adapt to how they're moving. Well, to get back to our question, right now, a little bit about me and how I, became a floor or worked on the floor, worked as a professional, a trader, right, for 10 years, and then became 5 years ago, got my broker's license. And now I help individuals manage risk in the commodity space, right? Because I like to talk, with my clients or, with people about how you're the captain of the ship, right? And this is true of commodity producers or speculative traders. Having other people there to be your first mate and captain, or first mate and navigator, can help in the situations of market turmoil and market exuberance to help keep things rational and keep things down to earth. Speculative traders, right? And I hate calling anyone a retail trader, but anyone who's not coming at the market from a commercial standpoint, right? Not trying to do and lay off actual hedging risk or provide market making services, is trying to make money in some form of either arbitrage or speculation due to price direction, right? And those traders need to find it in themselves to promote those qualities, right? Of discipline and of taking the emotion out of the trade. Those are things that don't translate well into a trade plan. Well, you think you get to this point where you might know everything fundamentally about a marketplace: corn, wheat, beans. I'm pretty fluent in the agricultural space. I help producers hedge those commodities. I've worked in the precious metals side. We have a precious metals desk at Zaner. So we do more than just the futures. We think we know a lot about these markets, but then 2020 comes around and teaches, I think, even some of the most veteran traders that futures prices can go negative. And
that was
right. I mean, that was an eye opener for a lot of people. And it's like, you think in the back of your mind, okay, how is this possible? And it makes sense. A futures contract is a delivered price of a commodity at a date. It's not the spot price. And we like to think about those front month futures as a spot. And the S&P can be a great example of this. It's not. It is the deliverable, right? 500 stocks that you can deliver against the futures contract, or it's really cash settled, but you know what I mean when we get to a delivery point. When oil needed to be delivered in 2020, there was no space for it to be delivered. So all of those people that were long oil would literally need to pay for storage to take delivery of that product. And so now the price of the product went negative to account for that extra delivery cost. And that was one of those things where, if I sat there and thought about it, I would have realized that, but it had never happened before, and no one needed to until that moment. And option pricing models for puts completely changed, because a put in the a short put position in the stock market, stocks can't go below zero, right? They just go to nothing. But because a futures price can go negative, now a short put position actually can exactly can demand more premium than the market going to zero, where technically, premium would theoretically cap out. That doesn't happen anymore. So even option traders had to shift the way they were thinking about put options at the time. And that was just one of those, again, proof that the markets will always humble you and teach you something new on a long enough timeline.
All right. So what's the next market to humble us?
Yeah. I think that is kind of a great leeway into, I think, maybe some of the psychology that's going on in the S&P 500. I've got the S&P 500, the cash index up on my charts right now. I hope everyone can see it.
Yeah, they can.
Great. So it's a weekly chart here. So every bar we're looking at is a weekly bar. You can see the monthly highs and lows with these blue and red lines. Okay, it's just a way of me seeing multiple candles on a chart. And if we went down to the smaller time frame, you'd see the daily highs and lows pop up. Anyway, I'm a big trend trader. I use Fibonacci retracements, 50%, 61.8, 38.2 lines to help define a characteristic of trend in the marketplace. Pretty simply put, I like to talk about markets as moving maybe 2 steps forward and 1 step back at times. And I think from that, what I like to refer to as the Millennial Black Monday low in 2020, of around 200 in the S&P, to now the highs, all-time highs at 4,818 there that we saw in 2022, 2023 almost. That period in the marketplace reminds me a lot of this post-recession marketplace that I remember in 2009 through to 2015, where it began with a lot of people selling into this rally, not believing new highs can be made because we have become so fixated on how bearish things became. And then we go into this period where quite literally bull markets start to climb a wall of worry. And that brings me to what I think and what my motto for the rest of the year 2023 will be, which is bull markets climb a wall of worry. I don't know if I'm contrarian or not here, but I have pretty much flipped my hat to saying, no, I think we are on our way and starting a bull trend that will take us potentially to new all-time highs. I don't think it'll be a straight line, but I do think we need to look into the past here and realize in some of these times of extreme market turmoil, the period immediately after seems to really surprise the general consensus as to what just happened. And there's this return to, better prices, return from the depths of a sell-off in the S&P and in risk assets that happens a lot quicker than many of us realize. Statistically speaking, if you look back over history, recessions usually occur with the stock market bottoming about 2 quarters before the economic recession happens. If the recession that is coming that we all believe here in 2023, there's a good chance that bottoming in the stock market has already occurred. Past price action is not indicative of future price action, but we're going to go look back here and go all the way back in time to a period in the late 70s. Let's zoom out on the chart here so I can get it for us and take a look at one of the last great recessions that the market went through. A period in the S&P where we rallied from single digits in the post-World War II economy all the way up to about 120 at all-time highs. From an Elliott wave perspective, you could see a flat correction, maybe an expanding triangle here, but a ultimately long-term continuation structure that pretty much traded from if you draw from 0 to all-time highs at the time, pulled back. The market had made 2 steps forward and 1 giant step back, pulling from the lowest low to the highest high there. All right, a nice big 50% retracement from about the 120 level down to 60 with a 60 low, shaved off 50% pretty quickly. That recession was, marred by the recession in the 70s, marred by the oil crisis, and then of course, into a savings and loan fallout. So we had a kind of a similar dynamic of what went on in the world to things that we saw in 2000 through 2009 is what I'm getting at. Wasn't a perfect relapse, but okay, a housing crisis, a recession low
Well,
of 60.
that low you have right there was in August of 1982. That was, in my view, the launching pad for the
right here.
40-year bull market.
I would absolutely agree with you. And you would see, and we'll see another one of those launching pads here in a second after Black Monday. You know, that was another opportunity that I like to call March of 2022. I like to refer to that as Millennials Black Monday. If this was Gen X's Black Monday, Millennials had their version of it in, you know, the post-COVID world. And there are many economists that now look back on this history and think, guys that are smarter than myself, and think, you know, there wasn't much to be fearful of when we look at that. This was a bond market sparked fear sell-off that didn't necessarily need to occur. And it seemed to be that once the bad debt was blown out of the system, so to speak, or the over leverage, the market was able to rebound. So let's go back to this quick recession in the 70s. We trade from this $60 area and blow through all-time highs eventually within a 10-year period, and we're up to a high of around 340. Interestingly enough, we flash forward to this pretty much 20-year span we have on the charts right here, you know, from 66 through 88, it's 22 years. Flash forward to a similar 20-year span from 2000 through where we are now, the chart doesn't look all that different. In fact, it almost behaved the exact same. Highs in the 15s, down to lows in the 600s. Those are pretty much our 1970s highs and lows multiplied by 10. A rally up to 3,300, almost to the 3,350 times 10, which would be 3,500 highs. So in terms of price expansion from a pure percentage play, this is logarithmically almost identical. And it's interesting that it took about the exact same time to get through that recessionary correction, you know, a 10-year period of a big flat like structure, or, you know, if we had chopped around a little more, it could have been an expanding triangle, but it's a flat to me, an expanding flat into, again, if you draw from basically zero to all-time highs at the time, 600 to 700 is a 50% retracement from 1500. So the market takes a giant 2 steps forward, recession is 1 step back, and the market then set up into another period of expansion, taking us to all-time highs. We have this big panic-like sell-off during the COVID crisis and what I refer to now as Millennials Black Monday. And the period that we saw after Black Monday, you very astutely pointed out that there were launching points back here in this in this period too. I just go to the most volatile one, I suppose, as I didn't have the opportunity to live through any of this. I've only ever had to learn about it on the charts. But I've used this as a model for how we can stay bullish through these times of uncertainty, right? Again, looking back on price does not completely indicate what's going to happen in the future, but this analog is playing out with way too much accuracy to, I think, ignore. So
what would change your mind?
What would change my mind? That's a great, let's put the pin in that.
Someone asked me that. You know what my answer is?
What?
And I'm surprised you don't have it. My stops.
Oh, sure.
My stops always change my mind.
And that was where I was going to.
I don't have to change my mind.
That's where I was going to come to the invalidation of this pullback that we're seeing here. A pullback, going back below this 3,400, falling back into this old all-time high. That's where, yes, if I was long from 3,500 and bought this 50% dip, my stops would have been initially at 3,200, and that'd be kind of my invalidation area. So yeah, I was going to say, let's put a pin in it because I'll tell you on the chart where it is, but you're right. You've got to have a reason and a rationale built into your system for changing your mind, right? Otherwise, it's just a self-fulfilling prophecy, right? If you're not trying to disprove yourself or allow yourself to be disproved by letting your stop get hit, by saying, when I go through this portion on the chart, I got to reassess the whole game plan. If you don't have that built into whatever you're doing, you're just trading a self-fulfilling prophecy that is forever governed by your bias and don't even know it. And that could be one of the biggest things for, a trader to lift the veils off their eyes and become truly objective. I think that's the secret. Try to disprove yourself religiously. Try to take the other side of what you're doing every day, and disprove yourself. And that's real scientific critical thinking, right? That's trying to prove a hypothesis, not trying to find why your hypothesis is right.
So there's nothing sooner than the October lows that would begin to
not necessarily there either.
Yeah.
So finally, to wrap up this old analog, right? We moved off of those lows in the past. We pushed up to new highs, and we have this pullback. When we go back to this Millennial Black Monday low, where are we? There we go. Black Mondays. We have this pullback, which is where I think we are at right in the marketplace. So we are effectively a couple years after that Black Monday type event. We've pushed to a new all-time high, and the market then has made this 50% pullback from that low to that high, right? So this is the part of the analog where we're at. So if we really take it even further, we're somewhere maybe right in here, right around 1991 going into 1992. And I think that this could be the type of price action we have to start our year off, right? We're in a correction, perhaps. We're going to put pressure on resistance, and there's very likely,
So would you call in your Elliott work the whole decline from last year, a wave 4?
Yes, of some degree. Yes, and this wave 5 that we're going to see, I also can believe can be another type of rare pattern in Elliott wave. Not rare. I think it's actually quite common in markets that expand and inflate in price, like the stock market kind of always has. So every 30 years, we tag on another zero because of inflation, pretty much. The idea here is that we can go into a 5th wave that is an extended 5th wave. And that's how markets go parabolic. That's how we would maybe make it to 10,000 in the S&P someday, and if this analog range true over the next 10 years, by 2033, you should expect the S&P to be trading at 10,000 and the Dow to be trading at, over 100,000. That's just inflation happening in the stock market too. So another short-term, I think, invalidation point is here. We have an inside month in the S&P, and let's actually start. Let's move over to the futures, where we can be a little bit more actionable on the E-mini and talk about it there. We've got this downward sloping trend line against the highs, which I think is very widely talked about right now. I've seen a lot of people talk about it myself. Exactly.
The whole universe.
It could be the biggest broadcasted potential breakout trade or not, right? And depending on how you draw it, we're either holding it, we're trying to break it, we went above it, we failed back below it. There's a whole dance we can have, an argument you can have over it. What I'm seeing, though, is that a market that was very much in a bear trend, I'm seeing it start to flip its script, and we're starting to hold some of the key technical levels you'd expect in a bull trend or at the infancy of a bull trend. The big 50% short from 4,800 down to 3639, this 420 or 4,223 level, we rallied up into it. We got a great reaction off of it. The market started making 2 steps down, 1 step up, but we failed to break below and towards their target. I use a negative 23.6% target, as well as a negative 61.8 line. Those are kind of like fib extensions that I use, right, as potential projection targets. That if I see a market move from a 50 to 61.8 line without really breaking above 61.8 lines, because once you get to that point, you can make a case that a market's starting to make more progress in the direction that you're not putting your fib up in. But the point is that we got a reaction, the market came down. We happened to find the big 50% level from the June or March of 2020 lows through the 4,800 highs. And now there's a fight over the trend between these two big levels. The bears don't want to see us go above 4,200. The bulls don't want to see us go below 3,500. Some big players and big money has taken their stance at those two levels, and we've range traded a bit, right? There's been a wrestling match going on. This downward sloping trend line against the highs comes into play because from a correction standpoint, it is a good indicator that if we start to go above, it can be an indication that there's some kind of short covering that could be occurring, which could become a prolonged, bear bull trend. Off this low from 3,500, however, we've seen now a 50%, 2 steps forward, 1 step back, 38.42 levels start to hold. If the market can push up to 4,300 and hit their targets, that's an indication of potential bulls, taking over from one of their levels and taking the market to an area where the bears probably don't want it to be. And it'll all be in the guise of breaking out of this potential trend line. And we're only in the daily chart here.
Yeah.
Breaking down further, let's go down to the 4-hour chart.
Okay, we just have a couple minutes left here, Dan.
Sure. Yep. Real quick, 50% retracement off the highs, hit 61.8 lines. The minute it did that, we pulled back into 50% longs, and we're on our way to our 40.91 target this morning while coming back above that high. There's a trend line against the lows here. 3,900, 3,800, wouldn't want to see them break for the lows in this inside month we have. But if we start to break above 4,100 and 4,200, I think the signal is on, and we'll see much larger institutional covering of shorts, and a bull trend might very well ensue.
So an inside month.
Yes.
The most bearish thing a market could do is take out the prior month's high and then the prior month's low. And the most bullish thing it could do is take out the prior month's low and then finish above the prior month's high.
Right.
So
3,800, 4,200 levels to watch here.
Yeah. So we'll see what kind of February we have.
It will be a very interesting month.
Are you old enough to remember something in commodities that used to happen called the February break?
No, I'm not, but I'm assuming.
Okay, okay.
Enlighten us.
No, I mean, it's just something that used to happen.
Sure.
I've seen a lot of major highs in gold and so forth.
Sure, and I've heard of selling May and going May.
And well, I bet some of your ad clients ask them about if they remember the February commodity breaks. So quickly, opinion on beans?
Yeah, soybeans, I think we've started to break out of a similar type of trend line. You could take a look at that on, corn as well. Daily chart here, the beans, right?
Yeah.
There was an old trend line through the highs here that we've broken above, and we're now just each trend line we're just trying to poke our head through. It's not a glorious trend, but it is a trend higher. And I'd say that the narrative we need to take us, not to 1,600, but beyond 1,600 is that we're going into planting season. We're going to need to see a disruption to planting with bad weather. And then, of course, if that carries through to bad weather this summer, we could see, new all-time highs in these contracts. And I say that because this is the type of carry out. In other words, we only have so much produced last year. There's only so much left over before the new crop is made. We don't have much. We only have about 1 month of domestic uses for soybeans laying around. That's not much to spare. No, that's historically the tightest it's ever been.
And we've had a lot of rain in California, which is unusual for La Nina year. So maybe there's a shift happening out there in the ocean.
In rain through March here, when planting starts to happen, is bullish for grains in this environment.
Yeah. Okay. Dan, it was great catching up with you.
Thanks for having me, Dale. It was wonderful to be on.
Yeah, nice presentation. My takeaway is Daniel Hussey Jr. is a bull looking for the potential of new all-time highs with lines in the sand in case it doesn't pan out. And we'll see what happens with the monthly candle next month, buddy.
Have a good one, Dale. Thanks for having me on.
All right. My trading warrior brother, Dan Hussey, everybody. And thank you, Dan. You could join the team in 14 minutes on the Morning Edge. And everyone have a great weekend. People are thanking you, and people could find you at Zahner, and your Twitter handle is at Daniel Hussey Jr.
That's correct. That's correct. At Daniel Hussey Jr. on Twitter. You can find me at Dan SOTD on Facebook, or shoot me an email, dhussey@zahner.com.
If you're looking for a commodity brokers, I believe that Dan has all it takes to guide you.
Thank you, Dale. Have a good one, everybody.
All right. See you, Dan.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.